Hi, everybody. Welcome to our Money Monday live webinar. Sorry for the slight delay. Had some trouble getting the live stream to start, but we are here now, so I am ready to get going. Let me start out by sharing my screen. All right, there we are. So hopefully we'll have a couple of people joining us today. If not, no problem. We still do the webinars. And if you're not able to make them live, of course, you can always catch the recording as long as you are a member of the Let's Crypto Mastermind. Any of the paid plans have access to the recordings. And the free plan has access to just the live stream. But the recordings, you have to be in the starter plan or above. Okay, so let's go ahead and get started. I've really put together a fantastic webinar today, I do believe. So let me go ahead and scroll down. So today's topic is DeFi and yield farming. So this week we started our new theme for the month of September, and the theme is actually DeFi and yield farming. So today, I'll get into specifically what we're going to talk about here in just a moment. I'd love to do my little intro. So hello, my crypto brothers and sisters. Welcome to another Money Monday live webinar. I'm your host and DeFi expert, Kelly Sunchal. Today's webinar begins our 4-week journey into decentralized finance and yield farming. My focus today will be the basics. And today's topics are going to include these 5 things. Number 1 is intro to DeFi. Number 2 is key components of DeFi. Number 3 is yield farming explained. Number 4, use cases of DeFi. And number 5, we're going to explore risks and challenges of DeFi. All right, I'm ready to go ahead and get started. But before we get into more details, I'm going to begin at the beginning with number 1, which is the introduction to DeFi. So let's start by defining DeFi, exploring its purpose for being, and then comparing decentralized finance to centralized finance. So definition, DeFi is a financial ecosystem built on blockchain technology that enables peer-to-peer transactions and services without intermediaries like banks or stock brokerages. DeFi utilizes a computer code technology called smart contracts. These smart contracts get deployed on decentralized public blockchains to provide digital financial services. And they're built primarily on Ethereum or Ethereum-compatible blockchains. DeFi smart contracts are designed to facilitate financial activities such as borrowing, lending, trading, and earning interest. Okay, what is the purpose of all this stuff? The primary goal of DeFi is to redefine the traditional financial system in an open, permissionless, and decentralized manner that enhances accessibility, transparency, and security for everyday people. DeFi platforms, for the most part, are designed to be inclusive, allowing anyone to participate and access financial services regardless of location, background, or economic status. However, some geolocation restrictions do currently apply, and I hope that that will change in the future, but unfortunately it is true for today. So other key objectives of DeFi include things like transparency. Transactions are recorded on a public blockchain, which allows for easy system auditing, which some people believe builds trust. I'm not sure if I 100% agree with that thesis that it builds trust, but I'll go into more in depth about that another time. Another objective of DeFi is self-sovereignty, and I do 100% believe in this concept. Users are empowered to manage and control their own funds and financial decisions, for better or worse. Another objective of DeFi is innovation. With the invention of smart contracts, new financial products and services can easily be created, allowing for rapid and diverse innovation. All right, let's go on to the next topic in our intro, which is a comparison. Since DeFi is attempting to become a better version of our existing financial system, let's compare DeFi with CeFi, and CeFi is, of course, centralized finance. CeFi is controlled by central authorities like banks and financial institutions, including the Fed, BIS, which stands for Bank of International Settlements, and the SEC, and many others like it. CeFi is not transparent like DeFi or decentralized finance. Anyone can review DeFi transactions if you know how, but CeFi transactions are not visible to the public. In DeFi, users maintain direct control over their assets, while CeFi requires a custodian. We'll explore this matter more later on, but I believe that DeFi and CeFi can work together if they're done appropriately. But we'll talk more about this concept later on. CeFi is typically more heavily regulated, meaning innovation and change comes very slowly. DeFi has very little regulation, but in my opinion, could use a little bit. Currently, DeFi is regulated by prosecution. What that means is we're not given any good regulatory oversight. We don't have any good guidance. These companies just find out that they've done something inappropriate by having the SEC or some other law enforcement agency come after them and prosecute them or attempt to prosecute them. So that's not a good way that's not a good way to regulate an industry like crypto, but that is currently what's going on. All right, let's move into number 2 on our list today, which is key components of DeFi. So now let's explore how DeFi actually works. What are the components of DeFi that make transacting via blockchains possible? The 3 main components of DeFi include blockchain technology, smart contracts, and decentralized applications known as dApps. So let's look at each of these briefly. Blockchain technology. The word blockchain has very much become a buzzword in the crypto industry, and DeFi is no exception. It starts and ends with blockchains. Everything about DeFi is either built on top of or within a blockchain. The word blockchain is used loosely in the industry because there are so many different kinds of blockchains. While it is unnecessary to fully understand all blockchains, when using DeFi, there are times when it might be necessary to have an understanding of them. For example, staking tokens to earn rewards or interest occurs only on proof-of-stake blockchains, not proof-of-work blockchains. So it's good to understand, at least about proof-of-stake blockchains if you want to stake. I'll talk more about staking later. Smart contracts. After the invention of the Bitcoin blockchain, the next greatest crypto invention was the Ethereum blockchain with smart contracts. Smart contracts were actually invented in the 1990s, long before crypto ever existed. However, the intelligent designers of the Ethereum blockchain understood how smart contracts could be used to make Ethereum do things that Bitcoin could not do. Namely, smart contracts automate financial transactions and enforce agreements by embedding code directly into crypto transactions. This functionality allows for much more complex financial transactions on Ethereum than Bitcoin. Let's talk about DeFi protocols. DeFi protocols are the foundational rules and mechanisms that govern how digital assets are used on blockchain networks. They are built with smart contracts. And DeFi protocols include DEXs, which are decentralized exchanges, lending and borrowing platforms, and staking platforms. And again, I'll go over more on all of these things in another training. Okay, let's talk about decentralized applications. dApps provide user-friendly interfaces that allow individuals to easily interact with DeFi protocols and access their services. The dApp front-end interface can look just like a website, but in reality, It bridges the user and the underlying DeFi protocol, making it easy for everyday people to use the technology. DeFi protocols are developer-centric and dApps are user-centric. Without dApps, we would all have to read and understand smart contracts, and we definitely don't want to do that. All right, let's move on to number 3 today. We're going to explain yield farming. And in simple terms, yield farming is a way to earn passive income with crypto assets. But let's go into it a little more in depth. So here's a definition. More specifically, yield farming is the practice of staking or lending crypto assets in DeFi protocols to earn rewards in the form of crypto tokens. Additionally, yield farming involves depositing tokens into liquidity pools on DeFi platforms to provide liquidity for lending, borrowing, or decentralized trades. In exchange for providing liquidity, yield farmers can earn a percentage yield as APR or APY paid out in real time. And I'll talk more about what those things APR and APY mean in a later training. Today, we're just getting into the basics. So now let's talk about how yield farming works. Yield farming operates through several fundamental mechanisms, and one involves an automated market maker, or an AMM, and liquidity pools. AMMs are decentralized exchanges that use algorithms to facilitate trading without the need for traditional order books. They allow users to trade assets directly through liquidity pools. And liquidity pools are collections of tokens that are locked in smart contracts that provide liquidity for trades. Users, which are known as liquidity providers or LPers, deposit crypto tokens into a pool, enabling other traders to do swaps. LPers then earn a portion of the transaction fees generated from those trades. AMMs use a mathematical formula to determine the price of assets based on the ratio of tokens in the pool. And the most common formula that is used is called the constant product formula, which is X times Y equals K. But don't worry, this is just information. We're not going to do any more math than that. I just wanted you to understand the basic formula that is used to determine prices on a DEX. All right, let's keep going. So what are the risks and rewards of yield farming? Now, since DeFi is still very early in its development, yield farming comes with both high returns and inherent risks. So we're going to talk a little bit about both of those. So for potential returns, you can get passive income, high yields, token appreciation, and we'll see what else is on my list. So passive income. By staking or lending their assets, yield farmers can generate passive income without actively trading, allowing them to put their idle assets to work. And that is why I love yield farming during bear markets. The yields might be a little bit lower during a bear market, but during a bull market, I don't want to have my tokens locked up. I might want to trade them. So anyway, passive income is number one in my book for yield farming. How about high yields? Users can earn very attractive reward rates compared to CeFi, such as interest, transaction fees, or governance tokens by depositing their assets into liquidity pools or lending protocols. I'm sure you're starting to hear a little bit of a consistency in the things that you do in yield farming. Liquidity pools and lending protocols, you've already heard a couple of times. How about potential returns as token appreciation? Besides earning interest, yield farmers may benefit from appreciating prices for the tokens that they receive as rewards. So you get a double benefit. If you earn the rewards, you earn an interest, and then in the tokens that you earn as rewards, if those go up in price, now you've gotten a double reward, you could say. So let's look at some of the inherent risks of yield farming. The first one is impermanent loss. This occurs when the price of the tokens in a liquidity pool diverges significantly from the price at the time of deposit. Now, it's a very important concept to understand in permanent loss, and I'm going to go into it quite a bit more in another training. For now, I just want you to understand that that is an inherent risk. And to say it more succinctly, if you deposit your tokens into a liquidity pool and the price of that token that you put in the liquidity pool starts to run up, you are missing out on the appreciation of that token price because you have it locked into a smart contract because you provided liquidity. So it's something that has to be considered. Other inherent risks, smart contract vulnerabilities. Yield farming relies heavily on smart contracts, which can contain bugs or programming vulnerabilities. And that's something we often hear about in the news. So it's important that the platforms that we choose to use have their protocols highly audited and audited by very qualified companies, not just anybody. Another inherent risk is market volatility. So the crypto market, as you all know, is highly volatile, and price fluctuations can affect the value of the rewards earned and the assets deposited. If the value of the tokens drops too much, it can erode any profits that you earn from yield farming. So yield farming is an art as well as a science. Another inherent risk, fluctuating yields. The yields offered by DeFi protocols can change quickly in a short period of time based on supply and demand dynamics. So as more users participate in a protocol, the returns may decrease, making it challenging to predict future rewards. I've seen many protocols start out as much as 800 to 1,000%, and within a week or so, they can drop down to 100% on their APR. So fluctuating yields is definitely an inherent risk. Okay, let's go on to number 4, which is what are the use cases of DeFi? I'm curious to see if we've had anybody join us. Let me just do a quick check. Nope. It's okay. So let's keep going. Use cases of DeFi. The bottom line for DeFi is how can it be used to make money or access capital? And here is a brief list of the primary uses of DeFi. Number 1, lending and borrowing. Need access to capital? No problem. On a lending and borrowing platform, users can borrow money against their existing crypto assets without credit checks. Now that's huge. Users can also earn interest by lending their crypto tokens to the lending platform. So you can actually earn interest by depositing tokens that you have that you don't want to borrow against, but if you provide them to the platform, you're going to earn interest for providing liquidity. Okay, let's look at the next one, which is decentralized exchanges or DEXs. These platforms allow users to trade crypto directly with one another without a central authority, which enhances privacy and control over your funds. There's centralized exchanges, of course, which is like Coinbase and Binance, and that's not part of DeFi in my mind. So we'll talk about those at another time. But DEXs are ways to do your trading on chain is the way we talk about it. Okay, let's look at the next possibility, which is tokenization. Tokenizing real-world assets is a wonderful use case. It's fairly new use case in DeFi. Tokenization refers to the process of creating digital representations of physical or financial assets on a blockchain. This involves converting assets such as real estate, art, commodities, bond funds, and even intellectual property into digital tokens that can be easily bought, sold, and traded via a blockchain, well, either on a centralized exchange or a decentralized exchange, they can be traded. Tokenization of real-world assets is a huge up-and-coming topic, one that I'm paying very close attention to. Okay, let's move on to the next one, which is stable coins, another use case. Stable coins are an essential component of DeFi, and they're potentially one of the greatest inventions of DeFi. They provide stability in volatile markets and enable future growth of DeFi services. They are typically pegged to a fiat currency like the US dollar, but that could change in the future. In fact, I've heard talk of stable coins being backed by gold or silver someday. We'll just have to wait and see. Stablecoins are increasingly being used for savings, cross-border payments, and even everyday purchases, like a crypto debit card. Okay, lastly today, let's look at the risks and challenges of DeFi and yield farming. We'll start out by looking at the risks. Smart contract vulnerabilities. Smart contracts can contain bugs or flaws that make them vulnerable to exploits, potentially leading to loss of funds. I mentioned that earlier, and it's definitely top of the list. Another one that I already mentioned is impermanent loss. Yield farmers providing liquidity to AMMs or DEXs can suffer impermanent loss if the price of the pool's tokens diverges significantly. Centralized points of failure. While DeFi aims to be decentralized, some components like oracles and admin keys can represent centralized points of failure if compromised. So I haven't talked about what an oracle is yet, but you got to remember, think about the fact that a blockchain is a self-contained unit. So in order for certain applications to be able to function, to do things, they need to get information from outside the blockchain. And that information is provided to them by what's called an oracle. And when it's appropriate, I'll talk more about oracles in a later training. Let's see, what's another risk here? Another risk for DeFi and yield farming is lack of regulation. The lack of regulatory oversight exposes users to more risks with limited recourse in case of fraud or project failures. That's number one issue by not having any regulation is all these rug pulls. If you put your money into a project that does a rug pull, you can't get your money back for the most part. Another risk is operational risk. Managing personal private keys, wallets, and crypto assets introduces operational risks for individual users who must remain diligent to safeguard their assets. You know, right now, crypto is still in its fairly early stages, in my opinion, so it's not super easy to use. You've got to be diligent about taking care of all the little things you got to manage, like I said, private keys, wallets, and your assets. Let's look at the challenges lastly here. So interoperability challenges. The interconnected nature of DeFi protocols creates systemic risks where vulnerabilities in one protocol can affect others. So when protocols are built on top of other protocols, for example, when you have a layer 2 blockchain built on top of a layer 1 blockchain, there could be systemic risk built into the system. And if there's a vulnerability in one, there could be a vulnerability in the other. So that is a challenge, and I know that it's being looked at by very smart developers. Here's another challenge: front-running and arbitrage bots. Malicious bots can exploit the transparency of DeFi transactions to front-run trades or profit from price discrepancies across platforms. So arbitrage just means like if the price of, let's say, Bitcoin on Binance was, we'll say it's $50,000 on Binance. And if the price of Bitcoin on Coinbase is $48,000, that $2,000 difference can be taken advantage of through arbitrage bots. In other words, a bot could go onto Coinbase and buy it at $48,000 and then turn around and sell it on Binance for $50,000. Just taking advantage of the difference in prices on each platform, not even thinking about whether the price goes up or down. So that's another challenge. There's a lot of bots in crypto right now. Another challenge is scalability and gas fees. Congestion on Ethereum or other blockchains can lead to high gas fees, and many of us who've been around a while have experienced that, making some DeFi transactions prohibitively expensive, which is why layer 2s were created in the first place, to try to deal with scalability issue and reducing gas fees. Another challenge is user education. Onboarding new users to DeFi requires a bit of a steep learning curve and education about the risks and best practices, which is why I do what I do, because I still very much believe in crypto and decentralized finance as the future of our finance. future of our financial world, and I want to educate people how to use it. I do hope that someday it will get a bit easier, but it is what it is for now. And lastly, in our webinar today is regulatory uncertainty. Evolving regulations and legal frameworks around DeFi create heavy uncertainty for projects and users. I think when this election is over in November, we will hopefully get a lot more clarity around regulations for crypto, which will make it much easier for people that are trying to build new businesses in DeFi to know where they stand. So that is all I have for you today. That's the end of today's webinar. I really appreciate for all of you who will listen to this recording. I hope you learned a lot about DeFi and yield farming, and I guarantee you we're going to get more into the details throughout September. So as always, please stay curious, keep learning, and share your thoughts or questions in the comments or chat. That's all from me for today. See you next week. Bye for now.